What are bonds? Who issues the bond? A creditor is an entity or person that lends money or extends credit to another party. A debtor is an entity or person that owes money to another party. Bonds are a type of loan or debt taken by governments, city corporations, and big companies to finance their day-to-day activities, to raise funds for infrastructure activities or to finance other needs. They are a form of debt on which interest is paid to creditors, usually semi-annually, and the principal amount is paid at the end of the tenure of the bond. Here, bond issuer is the debtor and person buying the bond is the creditor. What is meant by the principal of bond? The principal of the bond, also called its face value or par value, refers to the amount of money the issuer agrees to pay the lender at the bond's expiration. The principal of a bond is usually either $100 or $1,000, but on the open market, bonds may also trade at a premium or discount on this price. In this example, the principal for the bond is $1 million as shown in the image on the left. More explanation is given in next image. Face value of bond. Face value is the money or the amount which the bond will be worth at maturity, for example after 10 years. Suppose an investor purchases a bond at $1,000 at the time it is issued and keeps it till maturity. After some time another investor also buys the bond from open market at a premium of $1,090 and a third investor also buys the same bond later when it is trading at a discount for $980. We assume that all three of them keep the bond till maturity. When the bond matures, all of the three investors will receive the $1,000 face value of the bond. Why the three investors bought at different prices? In the earlier example, you read that first investor purchased a bond at $1,000, the second investor purchased it at a premium of $1,090 and the third investor purchased it at a discount for $980. But when the bond matured all three of them received the $1,000 face value of the bond. In the next images, I will explain why the bond prices go up or down, and we will also learn why the other two investors bought the bond at different prices and what factors led them to buy the bond at higher or lower prices. Also, did the second investor made a wrong decision to buy the bond at a higher price? What made him do so? But first let us learn a few things which are important to understand the bonds in a better way. What is coupon rate or interest rate of bond? The coupon rate is the rate of interest which the bond issuer will pay on the face value of the bond. It is usually expressed as a percentage, say 7%. For example, a bond with a face value of $1,000 with a 7% coupon rate means that bondholders will receive 7% multiplied by $1,000 equals $70 every year. These are usually paid semi-annually in 2 installments of $35 each. Different types of bonds. 1. There are many different types of bonds. They vary according to who issues them, maturity date, interest rate, and risk. There are 4 categories of bonds sold in the markets depending on who issues them. Corporate bonds are issued by companies. Municipal bonds are issued by states and municipalities. Government bonds such as those issued by the U.S. Treasury or other central banks. Agency bonds such as those which are issued by government-affiliated organizations such as Fannie Mae or Freddie Mac. In this video we will primarily concentrate on government bonds which are issued by the U.S. Treasury or other central banks. Different types of bonds. 2. U.S. Treasury issues many different types of bonds. They vary according to maturity date. They are commonly known as Treasury bills, notes, and bonds. Treasury bills are issued for terms of less than a year. Treasury notes are issued for terms of 2, 3, 5, 7, and 10 years. Treasury bonds are issued for terms of 30 years. Usually financial markets track the 10-year Treasury note and 30-year bond prices. The rates of U.S. Treasury bills, bonds, and notes also affect fixed mortgage rates, but we will come to that point later where I will explain it also. Let's us learn more about bonds first. There are 4 major central banks in the world as depicted in the image. The policies and interest rates set by these banks influence the global financial activities, prices of commodities, values of currencies, and also the stock prices in the world. U.S. bond market. Holdings and trading in U.S. bonds by market size. Here you can see the amount of U.S. Treasury bonds held by different types of institutions till date. Why bonds prices go up or down? Governments across the world issue bonds whenever they need money. These bonds are issued at different interest rates over different period of time. The interest rates can vary due to many factors such as demand and inflation, etc. In our earlier example, the first investor purchased the bond with 7% interest rate at a price of $1,000. Now after a year or two, new bonds are issued with a lesser interest rate of 6%. Then the earlier bond with a 7% of interest rate would be much attractive to a new investor since it pays more interest compared to a new 6% interest rate bond. In such a case, the price of earlier bond will rise in secondary market, where the bonds are traded, to $1,090. Similarly, if later after few years, a new bond is issued at an interest of 7.5%, then the new bond will be more attractive to a buyer compared to a bond with 7% interest rate. Now if someone wants to sell his 7% bond in the secondary market, then the price for that old 7% bond will drop to $980 so as to make it attractive to a new buyer. What decides the price of bonds in such cases? It is yield of the bond. I will explain yield in next sections. So what is yield? What is its relevance? Yield is simply the return you will get every year till the maturity of a bond if you invest $100 in a bond. Let us learn with an example. Say John buys a 10-year maturity bond with 7% interest at face value of $100 when the bond is issued. His yield will be 7% per annum. After 2 years, Catherine buys the same bond for $98, with 8 years left. Now her yield would be 7.33%. So, if the price of bond goes down, the yield goes up. Which simply means that you would be getting more returns if you invest in a bond with a higher yield. Now assume that after 4 years, the price of bond rises to 102 and Jenny buys the same bond, with 6 years left, her yield on the bond would be 6.59%. So now, if the price of bond goes up, the yield goes down. Which simply means that you would be getting lesser returns if you invest in a bond with a lower yield. What happens when yields go up? Relation with stock markets. Usually, when the central banks increase interest rates, the newer bonds with higher rates are more lucrative to new buyers. In such a case, no one will buy the old bonds, so the prices of old bonds go down to make them lucrative to the new buyers. As the bond prices go down, the yields go up on the older bonds. The increase in yields means that these bonds are now more lucrative to new buyers. This usually generates a flow of cash in the bonds. Now if $100 invested in stock markets are yielding a return of 3% and meanwhile a bond is giving a yield of 3.5%, then obviously investors will sell the stocks and buy the bonds. So usually, whenever yields go up, there is flow of cash from stock markets to bonds, which means stock market falls whenever bonds yields go up, especially as compared to returns on stock markets. How do I use this knowledge for my benefit? You should try to find out how much your investment in stock market is yielding you. If the yield from stock market is lesser than the bond market, you should consider switching your investments to bonds. Bonds are much safer and considered low-risk investments than stock market. Try to find out the yields for different types of bonds available in the market and opt for the best one. Caution: some bonds of companies which are in losses may be trading at very high yields. Do not invest in such bonds. Usually, bonds are categorized with risk assessment. This will be explained in the next part of the series.